Hello everyone, welcome back to the Torrin Dove Financial Channel. Recently, an executive order just went into place that now is allowing private credit and private equity opportunities into your 401k. Now, these can be kind of tricky to properly understand, and I think a lot of people won't actually take really any time at all. I've been surprised how often I've talked to adults who don't really even necessarily know what exactly their 401k is even invested in, or they just kind of select one of the three options they get or something like that. And the self directed ones, I mean, it makes sense. It's not everybody's cup of tea. Nobody is just like always going to know everything, and if you don't necessarily care about investments, you probably aren't going to spend significant time outside of work or outside of school or whatever to actually learn about these opportunities and also kind of understand the risks and really understand what's going on. So recently, I actually got the privilege to attend a webinar hosted by Goldman Sachs, and they basically were going over all things private credit. Now, one of the interesting things I've seen with some of these professional webinars is it's not so much like trying to teach you things. That's definitely a part of it, but it's more or less a glorified sales pitch. And oftentimes it just comes with the added benefit of kind of deep diving in a topic. So obviously Goldman Sachs was trying to go over the investment opportunities that we as investment professionals, I put that in air quotes because when I was doing this, I was an intern. And so obviously I wasn't going to be taking any client's money and pouring it into private credit funds. But basically the argument was to kind of educate people who haven't necessarily invested into private credit in their clients' portfolios and kind of understand what that looks like and what that process is going to be like. So, one of the things I found really, really interesting with this webinar is that Goldman Sachs only takes low to single digit percents of the opportunities they're given. So, if 100 people come and ask Goldman Sachs, hey, I want to lend and I want specific terms that are different from what I could get in public markets or through a bank, can you work with me on that? They'll only take about 3 to 6 ish people out of that 100 people. So there's definitely, like, they didn't come out right and say that this carries significantly more risk, because obviously it's going to carry a lot more risk if these are people who are trying to get better terms or trying to get more money than they could get through a bank, or they want to kind of skip some of the grading portion of that. And Goldman Sachs has to be like working directly with their clients to make sure that, okay, do we think they can pay us back in a proper manner? Do we think that this is going to be a good investment? And if they're only taking 4 to 6 people, that means the vast, vast majority of instances that companies need extra funding or different terms, it's not necessarily a good fit for them. And so I'm bringing that up because a lot of times when we're looking at more of the marketing material that's being pushed onto us because they want our money in these funds, it doesn't necessarily bring up the significant added risk. It tries to just highlight that the companies want different terms and they want to, maybe instead of getting everything once in a lump sum amount, they want to kind of get it in intervals so that they can kind of deploy it in a better manner or something. And that makes a lot of sense, but when you look at some of the like notably large clients, these aren't companies that are thriving in the mainstream necessarily. They're like the Walgreens of the world or something. And there's going to be a lot more risk when you're invested in those types of funds. So, again, going over through the webinar and kind of experiencing that, there was definitely a notable shift around the 30-minute mark when they started kind of pitching to us, okay, how can you actually invest in these funds? Because I'll be transparent and fully honest, two things can be very true and also kind of contradictory. Private credit opportunities are incredible. I definitely think there's a good market for companies that need better terms than what they can get through a bank. And then there can be a lot of money. I mean, they were talking about maybe charging 2% higher typically for similar terms and similar loans, but just giving more freedom to the client, and the client would value that 2% more. And I understand that. But also, the investment opportunities in that space for individual investors, a lot of which aren't going to spend the time to actually read through a fund prospectus, aren't going to look into all of the terms, aren't going to understand that it's a really long commitment. And I'll get into a more like personal story I like kind of came through and experienced myself, but they aren't going to spend the time and understand that, okay, yes, they'll see that they're getting a larger percentage. What they won't necessarily see is that the expense ratio is significantly larger, basically eating away the added benefit of taking on that much risk. And so when you're kind of comparing that to a very low cost corporate, even corporate intermediate bond fund or something, where it's again going to be a low expense ratio. Typically, you can find that in an ETF format, and you're going for a more actively managed private credit fund, then the expense ratio is going to kind of eat away all of the added benefit you got from being in a much, much riskier fund. Additionally, getting to something I kind of witnessed firsthand, so when I was an intern, I won't get into specific, obviously, on like people or whatnot, but there was a client who passed away who was in a fund, and I believe it was a private equity fund specifically. But they were much older when they entered into this. Now, that was a problem because when we were trying to get as much of the capital back to give it to the people in the will, then we were only able to kind of get 75% of the capital back. And it's not like, oh, they stole us. No, these were the terms that were set in the prospectus, because again, a lot of how these PE and private credit and all those things funds kind of work is it's not like an ETF where you can just hop in and out, in and out. No, there's more like a set date, and it's kind of like a 12 to 15 year commitment where there's a period where they're pulling in as many investors as they can, getting as much money as they can, and then there's almost, I don't want to say it's not like a lockup period because you still can get out, but it's kind of like pulling out of a CD early where you're getting charged a lot. And if you're only in year 3 of this 15-year commitment, there's a real chance that you aren't even getting any profit at all and you're actually losing money even if the fund performed well. And so basically it makes sense because they have this structure to be for long-term purposes, and they want this to be a committed like holding money through periods where there's going to be downturns or during a financial crisis. They want their clients to not panic sell and freak out because then it's hard for the managers to actively pick projects that they can work on. And I fully understand that. But again, this is somebody who got sold this at a very late age. When you're talking about specifically the sales side of finance, these people aren't trying to find what the best fit for the client is. No one should have ever sold this particular person something that was a 12 to 15 year commitment. They're not going to be around that long. And you're going to get a lot of that where you're now going to have different brokers and more the salesy side of finance trying to target people who maybe don't know anything about investment to get into these types of very high expense ratio funds, where also there's the added benefit of the first time the market goes red and a lot of these people panic sell, oh my god, it's the end of the world. Like, even just go back to Liberation Day, how many people were panic selling. I mean, obviously in the moment it's going to look really bad, it's going to be hard, it's going to be like really hard to just say no. I know I'm going to lose some money now, and it's not going to be good if I open my Schwab, my Robinhood, my Fidelity, whatever, but I'm going to put my head down and go through it. Most people don't have that at all. They see their money. They haven't been able to kind of disconnect and just like view it as numbers on a screen. That is, and it makes sense. It's kind of a hard thing that kind of just you need to learn to do. So like if I woke up tomorrow and my account was down like 50%, I've trained myself to the point where me viewing those numbers, it's not like, oh, associate that with a car, associate that with a year's rent, associate that. Like, it's not anything like that for me. Instead, it's more like, oh, okay, now I have more buying opportunities. But most people, they aren't going to be like that. They aren't going to be advantageous in those periods. So the private credit and private equity funds are actually benefiting from having the people pull out early when they can only get 75% of their return, and then the managers are able to keep the cash and keep using it. Again, it makes complete and full sense, but people are not prioritizing transparency, and it doesn't benefit them to prioritize transparency, because if they were transparent, they would attract significantly less investors. And a lot of what I'm saying has been used with great success. So, like, when you look at some of like the early funds that like Warren Buffett kind of ran on a personal level, where he had like 80 or so clients who he knew in his town, and they came to him specifically, and he was very transparent, and oh, I'm going to be doing this is not a short commitment, this is like a 3 to 5 year minimum commitment. I really need you to only partner with me if you're not going to pull your money out immediately in the case of a downturn, or in case of a bad investment or something like that. And again, you don't always find people with that type of moral compass. Instead, you find companies that just want to make more money, and you're just a dollar to them. You're not a person to them, you're a money amount. And again, it makes sense. They're not on that personal level necessarily, and it doesn't benefit them at all to be transparent. But me talking about this, I'm just trying to kind of set the playing field. So if you're going to participate, which again, I'm not necessarily a huge fan of participating. Again, I think there's great opportunities in private credit and private equity, but I think for a lot of the people, especially on the private credit side, the opportunities come with the companies who are actually lending the money. It doesn't come with the individual investors trying to follow a hype train. Same with private equity, where you can't necessarily value things, and it's up to the manager to kind of pick where the valuations are. I don't see as good an opportunity for the average investor in their 401k when they have to add on all of the risks, all of the difficulties of investing in these illiquid assets, compared to just parking in an S&P 500 and a total world ETF and calling it a day. There is no real benefit. The whole idea of, oh, you're going to be able to sleep at night better if it's private, which, believe me, is something that consistently is thrown out. It really only works if you fully 100% comprehend, understand, and can talk through and teach somebody on the specific type of fund and deal you are in. That's the only use case scenario, is if you become a master at it. And talking to the average person, they aren't a master at investing in their 401k. And it makes sense because they work and they have all of these things. So, quite frankly, if you don't have the time to do the research, do not invest in these opportunities. Yes, they're very flashy. They're a hot trend right now. You're going to hear people who are like, oh, why are you investing in that bond fund? I'm invested in this fund and it yields slightly higher. But there's going to become a day, because it sounds very 2070, 2080. And part of that could have been because I just watched The Big Short literally right before the webinar. But again, there's going to be a day where these people, having not read through, because we've become accustomed to any time we have to read through something or should do due diligence, they might have thrown it in ChatGPT. They could have not even done that. They could have just written their name down, signed the signature, and called it a day. But be mindful, be open-minded, understand all of the opportunities that are out there, and in a similar path to, if you don't have time to thoroughly research single stocks, why would you ever take the added risk when there is something with a consistently great proven track record that requires little to no attention whatsoever? So again, I would lean on the side of the vast majority of people don't invest in it. I almost would certainly say don't at all, just in general, but there is the potential that if somebody's willing to do the research and willing to do the work and search through all the different funds, they can find one that actually has favorable terms to the individual investors who would want to park that in their 401k. I'm not saying that all money managers are evil or anything like that, and a lot of them probably aren't at all. It's just it doesn't incentivize them whatsoever to necessarily make sure it's the best fit for you and you personally. They have to deal with significantly larger fish in the sea. They're trying to attract institutions. They're trying to attract pensions now. They're trying to attract all of these big figures, and they just don't have time to make sure it's necessarily the best fit for you and your 401k. You are kind of on your own on that front, trying to make sure that you pick things that are good for you. So, anyways, thank you for letting me ramble a bit about private credit and the private asset opportunities that are coming to your 401k. Again, I'm now in, well, I would say the new setup, but it's the old setup. It's the original setup. I'm back in the apartment, and I'm excited to get started with school. I think I'll be able to kind of make a couple videos a week, so we're going to try and ramp up the intensity as I get going, because I have really been enjoying this, and the videos comparatively have been doing well recently, and that's very exciting for me. So, thank you very much for checking out today's video. I really appreciate your time.